The impossible just happened. 3 days ago, the United States executed the most audacious military operation in Latin American history. They captured the sitting president of Venezuela. They seized control of an entire nation possessing the world's largest proven oil reserves, 303 billion barrels. That is 17% of every barrel of oil buried beneath the surface of this planet. The operation killed 32 Cuban military personnel and at least 24 Venezuelan security officers. The United Nations condemned it. Russia and China issued threats. NATO allies publicly criticized the action. And when the markets opened on Monday morning, oil prices did not move. Brent crude rose 0.2%. West Texas Intermediate climbed 0.4%. By Wednesday, prices had actually fallen. This is not just a market anomaly. This is the death certificate of the geopolitical risk premium. For 40 years, capturing an OPEC president would have sent oil prices to the moon. Today, the market responded with a shrug. To understand why reveals the most important shift in global energy markets in a generation. And it changes everything you thought you knew about oil, power, and money. Let's get the numbers on the table first, because the precision matters. Monday, January 5th, first trading day after the operation, Brent crude opened at $60.57 per barrel, up 12 cents. West Texas Intermediate hit $58, up 23 cents. These movements sit well within normal intraday noise. There was no panic, there was no scramble, there was no strategic reserve release. By Tuesday, prices fell. Brent dropped to $60.36. WTI slid to $56.54. When President Trump announced that Venezuela would deliver 30 to 50 million barrels to the United States, the market took it as bearish news. More supply, lower prices. Phil Flynn, senior market analyst at Price Futures Group, called it potentially a historic event for oil. Within 48 hours, the market rendered its verdict. Venezuela does not matter. Not today, not in this environment. The question is why? To understand the magnitude of this non-reaction, you must look at history. In 2011, Libya descended into civil war. The country's oil production collapsed. 1.6 million barrels per day went offline. That is nearly double what Venezuela currently produces. The result was immediate and catastrophic. Brent crude exploded from $92 in January to $120 by April. A 30% surge in 3 months. Refineries in Europe scrambled for alternatives. Nigerian Bonny Light, a substitute for Libyan crude, jumped from $98 to $128 per barrel. The price differential between Bonny Light and Brent widened from $2 to over $4. The market was in full panic mode. Go back further. The Iranian Revolution in 1979 removed 5.6 million barrels per day from global markets. Oil prices quadrupled. They stayed high for a decade. The world economy restructured around energy scarcity. Even the Arab oil embargo of 1973, when exports fell 60 to 70%, triggered a fourfold price increase that redefined geopolitics for a generation. These were not marginal events. They were civilization-altering shocks. Venezuela 2026 was supposed to be the same. It was not. The difference is not Venezuela. The difference is the structure of the market itself. The global oil market is drowning. The International Energy Agency forecasts a surplus of 3.8 million barrels per day through the first half of 2026. Let that sink in. The entire world is producing nearly 4 million barrels more oil every single day than it consumes. Venezuela's total production, at its current degraded state, is 800,000 to 950,000 barrels per day. That represents less than 1% of global supply. Even if every single drop of Venezuelan oil vanished overnight, it would account for only 20 to 25% of the existing glut. The oversupply is so massive that Venezuela's output is a rounding error. Deloitte Canada projects West Texas Intermediate will average $58 per barrel for 2026. It is trading at exactly that level right now. TD Securities stated it plainly. A squeeze above $60 is not sustainable. Any immediate supply disruptions are mitigated by the ongoing glut. This is not speculation. This is mathematical reality. The market has more oil than it knows what to do with, and Venezuela cannot change that equation. But the story gets worse for anyone betting on a Venezuelan oil renaissance. The infrastructure is gone. 25 operational pipelines have not been upgraded in 50 years. Daily oil spills occur. 3 out of 4 major upgrading units, the facilities needed to make Venezuela's extra heavy crude transportable, were down after unexplained explosions and fires in recent weeks. The domestic refining capacity has been decimated. Venezuela, sitting on the largest oil reserves on Earth, must import gasoline because it cannot refine its own crude. The electrical grid suffers chronic outages that disrupt pumping stations. Thousands of skilled petroleum engineers, geologists, and technicians fled the country during the collapse. The brain drain hollowed out operational capacity. Industry analysts estimate it would require $8 billion in immediate investment just for basic repairs. Full restoration to early 2000s production levels would demand $100 billion over 10 years. Francisco Minaldi, director of the Latin America Energy Program at Rice University, stated it clearly. Restoring Venezuela to its former glory would be measured in years, not months. Even with optimal conditions, political stability, full sanctions relief, massive capital, the timeline is a decade, not weeks, not months, a decade. And here's the profitability problem. With Brent trading around $60 and Venezuelan heavy crude selling at a $25 discount, the net realization is approximately $35 per barrel. Production costs in Venezuela's degraded infrastructure run $25 to $40 per barrel. The margins are razor thin to non-existent. No rational company will deploy billions into a project with these economics unless oil prices double. They will not double. The glut prevents it. While oil prices ignored the chaos, other markets told a different story. Energy stocks exploded. Chevron surged 7 to 10% on Monday. ExxonMobil gained 4%. ConocoPhillips up 4%. Refiners like Valero and Phillips, 66, jumped 7%. Energy services companies, Schlumberger, Baker Hughes, Halliburton, all rose 7 to 9%. Why? Because investors are betting on infrastructure contracts. They are betting on a multi-year, multi-billion-dollar reconstruction effort. They do not care about oil prices. They care about service revenue. Meanwhile, safe haven assets showed life. Gold rose 2 to 3%, pushing above $4,450 per troy ounce. Silver surged 4 to 7%, hitting approximately $76. Platinum gained 5.7%. These moves reflect geopolitical unease, but they are modest compared to historical crisis responses. The precious metals market is hedging risk, not fleeing to safety. This is a tactical adjustment, not a panic. The stock market treated the entire event as a risk on opportunity. The S&P 500 rose 0.6%. The Nasdaq gained 0.8%. The volatility index remained subdued below 16. Investors are not worried. They see a swift resolution with minimal escalation. They see access to Venezuelan oil as a long-term positive for American companies. Campbell Harvey, senior advisor at Research Affiliates, warned that markets may have become dangerously inured to risk after a 3-year rally that pushed stocks up roughly 80%. He is right to worry. When a military operation that captures an OPEC president generates a stock market rally, complacency has reached extreme levels. China is the real loser in this equation. Venezuela supplied approximately 600,000 barrels per day to China in 2025. That crude sold at a $25 discount to Brent, meaning Chinese refiners paid roughly $35 per barrel instead of $60. The teapot refiners, independent operators running on razor-thin margins, depend on these discounts to survive. They are now forced to switch to Iranian heavy crude, which trades at only a $10 discount, or more expensive alternatives. China has 82 million barrels of Venezuelan oil stored on tankers off its coasts, enough to buffer the disruption for a few months. But longer term, this hurts. Beyond oil, China has $4.8 billion invested in Venezuela at risk. Venezuela owes China $10 to $12 billion. The Belt and Road Initiative counted Venezuela as one of its largest loan recipients, $62.5 billion since 2007. All of that is now under American control. Beijing issued the predictable condemnations, calling it typical bullying behavior. But China lacks power projection capacity in the Western Hemisphere. They cannot reverse the situation militarily. They cannot economically retaliate without jeopardizing trade negotiations. China is boxed in, and they know it. Michael Maiden, director of the China Energy Program at Oxford Institute, stated plainly, "The loss of Venezuelan barrels hurts teapots the most. The Chinese economy is already struggling with property sector weakness and deflation. Losing access to cheap crude adds pressure to an already stressed system." OPEC held an emergency meeting on January 4th, the day after the operation. Saudi Arabia, Russia, Iraq, UAE, Kuwait, Kazakhstan, Algeria, and Oman reaffirmed their decision to pause production increments in February and March due to seasonality. Translation: OPEC looked at the oversupply numbers and decided that adding more barrels would crater prices. They chose price support over market share. Bjarne Schieldrop, chief commodities analyst at SEB, nailed it. The global oil market in 2026 will not be about Venezuela. It will be about OPEC's balancing act between oil price and market share. OPEC is sitting on approximately 4 million barrels per day of voluntary production cuts. That is more than 4 times Venezuela's entire output. If Venezuelan oil vanishes, OPEC can restore it from cuts. If Venezuelan oil surges, OPEC can maintain cuts to absorb it. OPEC has far more market power than Venezuela ever will. The cartel's decision to hold production flat is the ultimate confirmation. Venezuela is irrelevant to the global balance. The structural shift here is profound. For decades, oil markets incorporated a geopolitical risk premium. Wars, sanctions, Revolutions all added dollars per barrel, reflecting supply disruption probability. The 1970s and 80s saw $5 to $15 premiums routinely. The Gulf War in 1990 spiked prices $10 to $20. The Iraq invasion and Libyan civil war added $10 to $30 premiums at various points. That era is over. In 2025, markets experienced Russia sanctions, an Israel-Iran war, Venezuelan tanker seizures, and Houthi attacks on Red Sea shipping. Brent crude fell nearly 20% through the year to just over $60. The geopolitical risk premium has collapsed to zero. Why? Because oversupply dominates everything. When the market has 3 to 4 million barrels per day of excess supply, disruptions below 2 million barrels can be absorbed without price spikes. OPEC has spare capacity. The United States has flexible shale production. Strategic reserves can be released. Derivative markets allow sophisticated hedging. The system has become resilient to shocks through abundance, not scarcity. European central bank research identified two competing mechanisms: the risk channel, where supply fears push prices up; the economic activity channel, where geopolitical uncertainty reduces growth and demand, pushing prices down. Historically, the economic activity channel dominates. Uncertainty kills growth. Lower growth kills oil demand. Lower demand overwhelms supply concerns. In the Venezuela case, even the risk channel failed to activate because the supply disruption is too small relative to the glut. The death of the geopolitical risk premium is not temporary. It is structural. It persists as long as oversupply persists. And oversupply is forecast to persist through at least the first half of 2026, possibly into 2027. Some contrarian voices argue the market is wrong. Tony Tong, Asia head of energy at Synergy Intelligence, warned not to underestimate the capacity of U.S. oil companies to ramp up Venezuelan production quicker than anticipated. Chevron already operates in Venezuela. They know the fields. They have relationships. They can expand operations immediately. If production ramps to 2 million barrels per day within 3 years, adding over 1 million barrels to an already glutted market, Tong predicts sub-$50 WTI. That would be catastrophic for marginal producers. U.S. shale needs $55 to $60 to sustain activity. Canadian oil sands need similar levels. A flood of Venezuelan crude could trigger a price war or force OPEC into even deeper cuts, destabilizing the entire market. The other contrarian risk is contagion. Venezuela alone does not matter, but Venezuela, as catalyst for broader instability, could. If Iran escalates in the Persian Gulf, if Russia retaliates in the energy domain, if Latin American producers face security spillovers, cumulative disruptions could reach 3 to 5 million barrels per day. That would overwhelm even the current glut. Markets are assuming the Venezuela operation remains contained. If that assumption proves wrong, the complacency will be punished violently. Campbell Harvey's warning about markets becoming too comfortable deserves attention. Every pullback has been a buying opportunity for 3 years. Investors have been conditioned to ignore risk. The Venezuela non-reaction may be rational based on oil fundamentals, but it also reflects a dangerous belief that nothing bad can happen. When markets stop pricing tail risks tend to materialize. The final lesson here is about power. For 70 years, control of oil meant control of the global economy. The country that could turn the spigot on or off dictated terms to the world. The 1970s oil shocks proved that lesson brutally. OPEC held a knife to the throat of the West, and the West restructured its entire economy in response. Today, that power has evaporated. The United States seized control of the world's largest oil reserves, and the price moved 12 cents. The age of oil scarcity is over. The age of oil abundance has arrived. This shift changes geopolitics at the deepest level. Energy leverage over adversaries no longer works when markets are glutted. The U.S. achieved regime change in Venezuela, but gained no economic leverage through oil prices. Sanctions, financial system control, and military force remain effective tools. Commodity markets do not. For investors, the message is clear. Fade geopolitical headlines. Focus on fundamentals. Inventory data, OPEC policy, Chinese demand, Federal Reserve decisions, these factors drive prices. Wars and coups do not. Range-bound trading between $55 and $65 per barrel is the most likely outcome through the first half of 2026. A potential tightening in the second half or into 2027 could lift prices back towards 70 to 80, but not before. For now, the glut is king, and the king bows to no one, not even the United States military. The verdict is in. When chaos fails to move markets, the market is not being complacent. The market is being rational. Venezuela. 2026 does not meet the threshold for material supply-demand alteration. The oversupply is too large. The disruption is too small. The recovery timeline is too long. The substitutes are too plentiful. The fundamentals are too bearish. Oil abundance has neutered traditional geopolitical leverage. The era when Middle East wars, OPEC decisions, and revolutionary upheavals dictated energy prices has ended. Markets priced in this new reality within 24 hours. Policymakers and analysts would be wise to do the same. The age of the geopolitical risk premium is over. The age of the glut has begun. And in the age of the glut, even capturing an OPEC president changes nothing.